Hello, okay, next quick fire video. So comparing four products, four different vehicles that we have here in the UK. A couple you should know, a couple people may not know. I'm not a financial advisor, go and do your own research. These are four very different products. Even comparing these alongside each other is a bit outrageous to even begin with. But it's just to give you a quick idea as this video as what sort of tax perks you may have in each one of these, whether it's money going in or money coming out, making profit, dividends, etc. Very, very high level, guys. So, first of all, your ISA. People in the UK will understand these. Tax is assumed to be paid before it goes in, i.e. you may have paid tax on your PAYE income. So, if you put £10,000 into an ISA, you've got £10,000 in your ISA. Capital gains tax-free, which means that any money made on growth or dividends within the ISA is completely tax-free. You can either withdraw it or you can keep it in there and allow it to build. But HMRC aren't particularly interested. It's within its own wrapper. And you can withdraw the money at any time. It's not locked away. But you're limited to £20,000 a year on the current tax year at least, into how much you actually put into this tax-free ISA. Anything more than that, you need to start thinking about a different type of account. Lifetime ISA. These are quite new in the UK. I believe they came out in 2017. These were aimed for younger investors who were looking to buy their first house. Or if, as a term suggests, almost like a self-funded pension, but without calling it the P word. And I say this because, again, tax is assumed paid for going in. It shares that with the ISA, capital gains tax-free on profit and dividends. However, they're locked within the account because the money is locked away until you decide to purchase your first house. Again, there's T's and C's around that. Go do your research. Or your 60th birthday. This is quite a complex ISA compared to the other one. There's other things that you want to be looking at, i.e. the age at which you can open it, the age at which you're limited when you're too old to open it, how long you're allowed to pay in for, and how long the account remains effectively dormant after your last payment. So there's lots of different thresholds and benchmarks here that you may want to go and investigate. The perk, however, with this is not the £4,000 limit. That was one click too soon. So the £4,000 limit is the most you can put in per year, but this comes out the £20,000 overall ISA. For example, if you was to pay £4,000 into your lifetime ISA, your ISA that we saw on the previous screen is now limited to £16,000. Okay. The perk, the government adds 25%, which means if you put in £4,000 into your lifetime ISA in a tax year, the government would give you an extra £1,000. That's 25%, which is not a bad deal at all when you think of it like that. Getting 25% instant return on your money, that is a pretty good deal. You struggle to find those sorts of things in many walks of life. But of course, the problem is it is locked away for a very long time. And generally, if you're taking this out, you're going to be probably quite a younger person. So you've really got to be thinking about the future here. And would you want the money a little bit sooner? Pensions, very, very complex. You could spend hours and hours talking about these and still not get to the bottom of them. So again, very high level. Anything I mentioned here, please do your own research. But tax can be reclaimed when paying in. A lot of people will be aware of this. So when you pay in, your employer can add a contribution. They can claim back from national insurance. You get a slight tax break, if you like, if that's the correct terminology to use here, because you pay in your gross, not your net. Capital gains tax-free on profit and dividends. People often forget to mention that because they think it's not. Well, it actually is, but only while it's maturing. Because, of course, you can't take your money out of your pension. So if your pension pot doubles, then great. You don't actually pay your tax on that all the time it's in there. Tax comes later. The earliest money release is, at the moment, 55 years old, if you want to take it that soon. But that is already scheduled to be pushed back. I think it's 57 years old in maybe 2028, I seem to recall reading. So depending on your date of birth, it's already been pushed back. And again, depending on your age, you could be looking at maybe late 50s, 60s, or who knows, even beyond, depending on when you reach this kind of this time. A maximum of 25 tax-free upon withdrawal. Again, when it comes to empty your pension pot, speak to a financial advisor, somebody who knows is much better than I do, because there are lots and lots of caveats and lots of great ways of doing things and bad ways of doing things. All depends on your circumstances. You've got things like drawdowns, annuities, etc. So maximum 25 tax-free. So you've got £1 million in your pension pot. Congratulations. You can take out £250,000 tax-free on the day, if you like. and then you get taxed additional income rates, again, depending on what sort of method you use here. Financial advisor will steer you in the right direction here, but this gives you a quick idea on tax breaks in and out. VCTs, these are venture capital trusts. They're investing in sort of small fledgling companies generally. And they're almost like a pre-AIM market for those who are familiar with AIM in the UK. It's a small cap or your penny stocks, but this is before they officially float. So a VCT would be a large bank or investment company, or sometimes even some individuals that might be backing this, some very wealthy individuals, and they'll be looking at very potentially growth companies or very successful companies that need the extra sort of help. A good way to think about this maybe would be if you've seen something like Dragon's Den, where you've got your wealthy investors who are looking to help a product onto its next step, but want to take a large stake and to help steer that company. This is very much what a VCT sort of is in the real world, if you like. Anyway, it's enough talking about that. You get a 30% tax rebate on the investment. It depends on your circumstances, i.e. how much income tax you're currently paying, but I believe the upper limit is around £200,000 at the moment, so you've got quite a bit of scope there in terms of when the government stop paying 30%, but it all depends on what your current income is. But this will go through, for example, your self-assessment. So you put £10,000 in the VCT, that will stay in the VCT, but then HMRC will give you £3,000 back for helping smaller companies. Now, again, it's not a bad deal. However, obviously, being smaller, they can be much more volatile. You can withdraw the money at any time, technically, but you need a 5 years minimum to keep those tax perks. Take it out too soon, you pay the tax. And the dividends and growth are capital gains tax free. So all the time you're making money on these, you don't have to pay anything to HMRC. And of course, you can always reinvest these dividends back into VCT and get a further 30% back on that. Again, not necessarily documented in many places. Well, thanks very much. Very quick, very short, very sweet. Thanks very much.